Hello, I'm Noelle Lim on ASEAN Speaks by Maybank Investment Banking Group. Our analysts across the region discuss recent economic data, their outlook and investment strategy in view of global inflation, growth headwinds, especially in Europe, and China's flash lockdowns. Winson, Phoon, Head of Fixed Income Research, moderates the conversation.
8 o'clock on Monday. A quick recap for last week. Global stock markets rebounded on easing concerns about the Ukraine crisis and a sentiment U-turn on Chinese stock after the government pledged support to the market. Major stock indices mostly ended higher by about 4 to 8% week on week. Energy commodity prices continue to soften, falling for a second week as the rhetorics have toned down on Russia cutting gas export to Europe. Brent crude prices fell 4% to about $108 per barrel, while the European natural gas benchmark plunged by 20%, now trading at closer to the level before the start of the Russia invasion in February. Last week, President Biden and President Xi spoke on a video call for almost 2 hours on Friday, where Biden warned of the consequences for providing support to Russia, while China continued to call for negotiation between Russia and Ukraine. There were a few major central bank meetings last week. Both the US Fed and the Bank of England hiked rate by 25 bp, while the Bank of Japan kept rate unchanged. All came in within market consensus. It was the first increase for the US Fed in this cycle and the third increase for the Bank of England. I think what is interesting is that the new FOMC dot plot is now guiding for 7 hikes in total for 2022, but it is fully priced in by the Fed funds futures. Later, we'll have Suhaimi to comment on this. And after the FOMC meeting, interestingly, a few voting members indicated that they are open to a 50 bp increase in the coming months if inflations remain high. On bond market, the 2-year Treasury yield increased more than the 10-year yield, flattening the 2-year 10-year curve to about 20 bp. And the US swap curve has flattened even more, with the 2-year 10-year spread narrowing to just 6 bp, very close to inversion. On China, COVID infections have been rising, as we know, since March, averaging a few thousand cases per day. While the numbers are not large compared to most countries, it is significant for China given its COVID zero strategy and most cities are tightening restrictions. But on a positive note, the China's Financial Stability and Development Committee of the State Council held a meeting led by Liu He last week and made a number of updates that aim at addressing market concerns. On Malaysia, Prime Minister Ismail Sabri announced another special EPF withdrawal. This week, the key economic data to watch out for include China loan prime rate, Philippines central bank meeting, and also inflation data by Singapore and Malaysia. And this morning, we have Suhaimi to comment on US Fed decision and Malaysia's special EPF withdrawal. Harbin on Singapore economic update, Thilan on Singapore equity strategy, Joye on Indonesia macro, Anand on ASEAN equities, Jacqui on Philippines equity, and we have Chi Wei on Malaysia, a telco update on the 5G network. And let's kickstart with Suhaimi. At the FOMC meeting last week, the Fed hiked rate by 25 bp, and they also signal a more aggressive tightening path ahead. Suhaimi, what's your take on the Fed decision and our expectations for 2022 given the high inflation and geopolitical risk?
Good morning, everyone. Fed basically have engaged in a lift-off of its interest rate hike cycle with a 25 bips increase at last week FOMC meeting. I think the key takeaway from that meeting is basically a more hawkish pivot or tilt by Fed. The main takeaway is the updated dot plots indicate a total of 7 rate hikes this year, totaling 175 basis points, and another 3 to 4 hikes next year to result in the Fed fund rate reaching 2.75%. Back in December, the guidance was 3 hikes totaling 75 basis points per year this year and next year, followed by another 2 hikes amounting to 50 basis points in 2024 to push up the Fed fund rate to 2.5%. So I guess what's happening here is Fed is basically focusing on its price stability mandate, given the inflation trends over there. As of February, inflation was at a 40-year high of almost 8%. Fed also raised its full-year inflation rate average for this year to 4.3% from 2.6% previously. They are taking the view that the economy can absorb the interest rate hikes, the aggressive trajectory in terms of Fed fund rate increases this year and next year. It's interesting to note that Fed's unemployment rate forecast for this year and next year is unchanged at 3.5%, despite the aggressive interest rate hike. And as far as economic growth forecast is concerned, they do trim 2022 real GDP growth forecast to 2.8% from 4%. But basically, the message here is US economy won't fall into recession as a result of Fed's rate hike. So I think overall, we're not fighting Fed in terms of guidance. We should expect there to be continued interest rate hikes in the next or remaining 6 FOMC meeting for this year. And I think Fed will basically stick its gun as far as interest rate hike is concerned, due to the fact that the view out there is they are so far behind the curve as far as dealing with inflation.
So, Suhaimi, on Malaysia, there was yet another special EPF withdrawal. I think it's probably the fourth one since the pandemic. And with EPF being the single largest holder for both Malaysian equities and government bonds, what do you think this will have? Do you think this will have a major impact?
I think to begin with, this round of withdrawal is estimated to be around 40 to 50 billion ringgit after the earlier 3 rounds of EPF withdrawals under the Lestari, Sinar, Citra that total about 101 billion ringgit. Concern, of course, is on how EPF is going to fund this withdrawal, given the fact that, as you mentioned, EPF is a major investor in domestic equity and bond market. But the way we see it, EPF have cash to fund at least 3/4 of that amount, considering that at the end of last year, 5% of EPF AUM, 1 trillion AUM, is in money market instruments. And don't forget that 37% or 38% of EPF's AUM are in foreign investments. So I think there will be a combination of the estimated 40 to 50 billion ringgit withdrawal from EPF scheme to be funded through cash, as well as some sales of foreign assets for investment. Essentially what this means is there should not be any sales of domestic equity, and there should not be any impact on EPF investment in domestic bonds.
Okay, thanks, Suhaimi. We'll move to Harbin on Singapore macro. Harbin, Singapore last week released the non-oil domestic exports. The growth slowed, I think, in February. And you have cut Singapore GDP growth forecast by 1 percentage point to 2.8%. Can you share what are the main reasons?
Hey, hi, morning, Winson. Yeah, so actually for the last few months, I think some of the macro data for Singapore has disappointed. Both the exports for January and February are disappointed. Remember that February exports, in real terms, exports actually contracted. So the nominal values were pumped up by higher prices, right? And also the manufacturing, even for January, also disappointed on downside. So I think some of the slowdown is already starting to show. So we've taken down our growth forecast for this year to 2.8 from 3.8. That's now below the government's 3 to 5% range. And I think we expect a couple of months the government to also downgrade. I guess we're the lowest on the street. But a couple of shocks why we took down the forecast. I think one is the interest rate path. As Suhaimi alluded at the start of the year, the dot plots just showed 3 rate hikes this year. Now it's moved to 7 hikes. That's a pretty steep increase. And of course, the Fed has also downgraded their US growth forecast from 4 to 2.8. So, Conservatively, we take down Singapore's growth forecast by minus 0.5. Singapore is very sensitive to the global economy. I think second is the all price shock. We've taken our forecast, right, for Maybank to average $100 now this year, as opposed to the average of $80 just 3 months back. So I think Singapore as well historically been hit. I think there are already big complaints about a sharp rise in electricity prices affecting not just households but also businesses. So that historically will cut off growth by minus 0.3 to minus 0.4. A third is, of course, the war, the European slowdown, and a deep Russia recession. Even if we take the Russian impact to be negligible, I think all in with all the what's going on, I think that can slice off another 0.3% of Singapore's growth. Singapore is somewhat, 10% of the exports goes to Europe. There's also a large portion of European travelers that comes from Europe. And of course, the fourth is the China and the supply chain disruptions. We've seen lockdowns happening now in Shenzhen. So it looks as if it could come in and out again over the course of the year. And of course, we are already hearing a lot of factories, including some that produce for Apple and so on, being impacted. So I think that takes off at least minus 0.2. Basically, when you add it all up, you get a downgrade of minus 1.4% or so. And we haven't really imputed the impact from the sanctions, right? We're not even sure how all these disruptions to payments and all that will impact growth and financial flows. And also there's the wealth destruction, which have not imputed an impact from the sharp correction in China stock markets. So overall, we're looking for a much weaker growth, and no recession as yet, but I think just a much weaker growth than expected.
How about Singapore's 3-month SIBOR forecast? Any change? I think currently is at about 0.7%, and it actually went up to as high as 2% in the last US tightening cycle.
Yeah, so we're taking up that growth forecast for interest rates. Singapore interest rates is pretty much left to what happens to the Fed funds rate. Singapore measures exchange rate. So we've taken out the 3-month SIBOR now up to 1.8%. Our earlier forecast was based on just 3 Fed rate hikes. Now with penciling in 7 and 2.2% for next year. Penciling another 3 rate hikes for next year. So that's a lot sharper than previously expected. And correspondingly, the SORA forecasts have also been raised.
Okay. How about Singapore inflation expectation? I think on Wednesday, we are going to have the February data. What is your expectation? Do you think it will keep going higher?
Yeah, so unfortunately, I think we think inflation will continue to climb higher and stay elevated. Commodity prices continue to rise in February, and I think food prices as well. And I think signs like rents and all that are still tightening. So we're looking at core CPI rising to 2.7 versus 2.4 in the previous month, at the closer, higher range of the government's boundary of 2 to 3, and headline inflation to be coming at 4.1%. This will be the last inflation data before MAS decides the monetary policy decision in mid-April. And I think they have little choice but to tighten despite slowing growth. And we're looking at a recentering of the band upwards, so providing more room for the Sing dollar to appreciate to reduce imported inflation.
Okay, thanks, Hakpin. Still on Singapore, we have Thilan to comment on equity strategy. Thilan, you have a report on the impact of European recession. Which sectors or companies do you think are more exposed? What is your recommended strategy?
Yeah, morning, Winson. Yeah, so Russia-Ukraine demand is not really big for Singapore, but Europe is sizable, as Hakpin said earlier. If Europe goes into recession, Singapore will feel the domino effect, and this could have a downside impact on corporate revenues, higher costs, as well as stranded assets. In terms of sectors, we see the industrial and commercial REITs as one of the key exposures to Europe because they actually have been doing a lot of M&A there and growing the asset base. Property developers also are exposed, and they have around 5 to 15% of their fixed assets in Europe. Transport names such as SIA and Comfort Delgro have sizable EU businesses, and tech also has fairly large markets in Europe. Finally, the Singapore banks have loan books where they classify rest of the world as around 14 to 18% of their total books. We believe most of that is developed markets, and Europe is a big slice of that. So that's something to kind of watch out for in terms of slower loan growth and so on. Now, in terms of strategy, we are living through very significant market uncertainty. So we take a barbell approach where we look for to balance defensiveness with structural growth. We want stocks with earning certainty and strong competitive moats. So names like CICT, Bumiputera Agri, SGX, Singtel, Wilmar. And also we want stocks that play to the longer term themes such as ESG, digitalization, emerging market consumption. So names like Comfort Delgro, CLI, TBS, Franken, UOB. Winson?
Going into higher interest rate environment, could you also comment what are the sectors that will benefit or the ones that will face more challenges?
Yeah, so if you look at the overall Singapore market, net gearing is actually fairly low at around 9%. So the interest cost burden is relatively low. But if you actually look at sectors where interest costs are more than 25% of their EBITDA, then you see sectors like the REITs, property developers, and industrials featuring heavily. So higher interest rate expectations, what Hak has penciled in so far, could actually shave 1 to 4% of REIT DPUs. A sector that will obviously benefit is the banks. NIMs could expand about 25 bips from where we are forecasting already. We've already built in expanding interest rates to current assumptions. But you might actually see some slight downside in terms of loan growth given the lower GDP forecast.
Okay, thanks, Thilan. We'll move to Indonesia. We have Joye on Indonesia macro. Joye, Bank Indonesia had a policy meeting last week and they kept the rate unchanged. What are the key takeaways from the BI meeting? And I think historically, BI interest rate tends to be more sensitive to the US rate changes. Any change to our forecast for Indonesia policy rate?
Good morning, everyone. Some of the key takeaways from last week's BI meeting. Firstly, on BI's expectations of the Fed, Governor Perry did acknowledge that the Fed could deliver 6 more rate hikes this year following the 25 bips hike last week. And he reiterated that the BI will keep its policy rate at 3.5% unless there are clear signs of inflation picking up significantly for Indonesia. Secondly, on inflation, BI continues to expect headline CPI to average within its 2 to 4% target range this year, despite higher global commodity prices. That's mainly because fuel subsidies subsidized fuel prices kept unchanged. And on the other hand, unsubsidized commodity prices are rising. The government recently announced the removal of retail price caps for packaged cooking oil that were in place since January, when cooking oil prices jumped by around 40%. Thirdly, BI downgraded its global GDP growth forecast to around 3.8 to 4.2% from the previous 4.4, as the Russia-Ukraine war presents downside risks. But on Indonesia's GDP growth forecast, it was kept unchanged at 4.7 to 5.5%, given that the fall in COVID cases, accelerated vaccination, and broader economic reopening will help to boost private consumption. We maintain our view that the BI will raise its policy rate by 75 bips this year, despite a more hawkish Fed. And BI can afford to be more patient this time, given that inflation still remains soft in Indonesia, just around 2.1% in February, on the back of the fuel subsidies. And also the rupiah is supported by the healthy external balance, given the rising commodity prices. We expect the first rate hike to be in May or June. But we do trim our 2022 GDP forecast slightly to 5.1% from the previous 5.4%, mainly on the back of a small downgrade in private consumption due to the Omicron wave in the first quarter.
Can you comment on Indonesia exports? I think for February's data, it actually picked up and trade surplus widened. further. What are the key drivers? Do you think this is sustainable?
Sure. So for February, total exports growth accelerated to 34%, boosted by coal, as the export ban was lifted on the 1st of February for miners that complied with the domestic market obligation for 25% of the output to be sold locally. And other key growth contributors to exports in February were iron and steel and nickel, as prices hit record highs because of the supply squeeze from the Russia-Ukraine conflict. Indonesia's top exports do consist of commodities like palm oil, coal, and metals such as aluminium, copper, and nickel. These have all seen prices surge since the start of the war, and high commodity prices will likely sustain the trade surplus, although this is partly offset by the widening oil trade deficit, given that Indonesia is a net oil importer. We raised our current account balance to forecast to a smaller deficit of 1.4% of GDP from the previous 2% on stronger commodity exports this year.
And Jue, speaking of Indonesia palm oil exports, they just imposed a new levy. Do you think this will slow the momentum going forward, let's say from March onwards?
Yeah, so for palm oil exports, in fact, in February, the data for February was not released for this time round, but we suspect there could have been a decline because of the 20% DMO rule kicking in January. The DMO rule was scrapped with the hike in palm oil export levies. We think the higher export levies could affect the exports, but having said that, given that palm oil prices have surged to record highs, I think that could help to cushion some of the higher export levies that exporters will have to pay. So I still think that the palm oil exports could hold up for Indonesia. Yeah, so we do expect to see an easing from the pace that we saw last year. Yeah, but it could still, that palm oil exports could continue despite the high palm oil export levies.
Thanks, Joey. We'll move to Anand on ASEAN Plus equity. Anand, you have a very comprehensive overview on the regional equities. Can you share what are the key highlights from the report?
Morning, everyone. Yeah, so for the last 2 weeks, ASEAN markets, which have been outperforming regional and global peers year to date, last 2 weeks have been a bit more sluggish. So we've seen markets generally trading water across the region. I think what we're seeing is market participants baking in renewed concerns about GDP growth. As mentioned earlier in this call, we've downgraded GDP numbers for Singapore and and Indonesia, and likely we'll do the same for the other ASEAN countries as the impacts of global issues such as China and Russia-Ukraine become more evident. So that's a bit of a concern for market investors at this point in time. The other, of course, is the inflation outlook. We've had central banks this month, Indonesia, Malaysia, standing firm, not moving interest rates higher, saying that inflation, at least for this year, is looking relatively controlled. But obviously, investors are looking further ahead and are thinking that central banks may be caught off guard and may be forced to raise rates earlier than they are signaling. So that's another concern for markets. Having said that, Winson, if you look at this chart here, figure 2, you'll see that ASEAN markets continue to be relative outperformers compared to our, especially our Northern Asian counterparts. And we think that will continue given the low beta defensive attraction of the region.
Okay, Anand, could you remind us of your Malaysia equity KLCI forecast for 2022? Any change given the challenges that we talk about?
Sure. Even though we are seeing markets trading water, there is an undercurrent of reopening optimism, not just for the consumer sector, but we are moving to the next phase of international borders also reopening. So if you look at our research over the last 2 weeks, we have raised the Malaysian aviation sector to positive from neutral before. Our top picks there are Malaysian airports and AirAsia. Also in Thailand, the tourism sector has been raised to neutral from negative before. And we've raised Centel and Mint there to buy from hold before. So reopening plays are getting quite a bit of attention at this point in time. For Malaysia by itself, coming back to your question, we haven't changed our index target. You can see that in figure 3 here, all the index targets for ASEAN all showing upside. Malaysia 1710. We're still looking for an 8% upside. But as I've always said for Malaysia, a more sustainable market rally, something not built on commodity stocks per se, can only be seen after general elections, probably in the second half of this year. So our target is second half loaded.
Thanks, Anand. We'll move to Jacqui to comment on Philippines equity. Jacqui, you have a report with some sensitivity analysis about the oil price shock, given that Philippines is a net oil importer, and you have the inflation sensitivity and also household expenditure sensitivity. Can you share with us your key findings and the impact on your equity recommendation?
Hi, good morning. Sure. So first, oil prices would have a threefold impact on the Philippine economy. Number one, given that food and transport account for over 40% of the CPI basket, our inflation forecast could move from 3.4% to about 4% in 2022 should oil prices average at $108 per barrel, which is based on the average Dubai crude oil futures as of March 9. At 4%, inflation could have been at the upper range of the central bank's 2 to 4% target range, which could trigger an acceleration in the policy rate hikes for the Philippines. And then lastly, as a net importer of oil, the peso tends to be reactive to energy price hikes, such that we could expect a 1 to 2% further depreciation of the peso at our $108 per barrel assumption. Secondly, oil-driven inflation has the most impact on the Philippine equities market. Excuse me. It can cut the consolidated earnings by 4%, while a 2% peso depreciation and a 50 basis point upfront rate hike together would only cut the consolidated 2022 earnings of the non-banks under our coverage by about 150 basis points. Majority of the debt exposures have fixed rates and peso denominated. Third, the consumer sector would definitely be the most vulnerable, while only 42% of the COGS and OPEX are oil and oil-driven cost components, such as transport, shipping, and wages. Its mass market orientation keeps its EBIT margins thin and doesn't leave too much fat for any kind of cost hikes. The property sector, on the other hand, would be least impacted. Not only is its oil-based cost exposure low at only about 30%, but also construction contracts are generally locked prior to construction, and cost movements shouldn't impact current projects under construction. Lastly, factoring in the higher inflation, weaker peso, and an accelerated rate hike, this would give us a worst-case scenario PSCI target of 7,800, which is still some 11% away from where we are currently. So the bottom line for us is, while the surge in oil price is definitely negative for the Philippines and is something to watch out for, current levels are not yet sufficient for us to turn really bearish on the market. So we are selective, yes, but not bearish.
Thanks, Jacqui. We'll move to Chi Wei to comment on Malaysia Telco. Chi Wei, what is the latest update on the government's decision on 5G network and the impact on the sector?
Sure. Hi, good morning, everyone. So the government essentially decided last week that the 5G rollout for Malaysia will continue via a single wholesale network operated by DNB. So telcos, meanwhile, will be allowed to own 70% of DNB, with the government owning the remaining 30%. Now, this to us is a win-win outcome for both the government and the mobile telcos. So on the government side, DNB continues to operate, so there's no issue of shutting down or breaking equipment contracts. For telcos, they regain network ownership and control, thus essentially preserving their longer-term relevance. Now, details of the equity participation are still being worked out with targeted conclusion in the middle of this year. So key issues to watch out for would be how the equity is divided among the telcos, as well as the cost of the equity. So overall, we think this is probably the best outcome to a messy situation. So stocks-wise, we continue to prefer Telekom Malaysia and Axiata.
Okay, thanks, Chi Wei. Thanks, everyone, for joining the call. Have a good week ahead.
Speak to your trading rep for our research reports or check out market insights on the Maybank Trade app. And also follow us on Spotify and Apple Podcasts. I'm Noelle Lim on ASEAN Speaks by Maybank Investment Banking Group.